Cathie, let me start with you. Known for your very bull case scenario here, $7,000 a share on Tesla by 2024. What gets you to 7,000?
There are a number of variables that get us there. The first is our forecast for electric vehicles in 2024 is 34 million units, up from roughly 2 million last year. So that right there is an exponential growth rate. The second is our gross margin assumption. We are using Wright's Law, which you may have heard us discuss before. Wright's Law gets us from roughly 20% on auto margins in the fourth quarter to roughly 40% during the next 5 years. And then we're also looking at capital efficiency. Capital efficiency, we see now from Shanghai that Tesla can build a car for roughly $1,000 in capital spending per unit. That is one of the lowest rates out there. And finally, our belief that Tesla is furthest ahead in autonomous capability. So in that forecast, we have a 25% chance or probability that Tesla will launch an autonomous taxi network within the next 5 years.
Cathie, another point that you mentioned on was their margins. Are you fully confident that Tesla is able to be profitable really from here on out?
Yes, on average, on balance, yes. I'd just like to address the autonomous points that Edward made. So autonomous is an artificial intelligence project. Tesla is taking a leaf from Apple's book here. Apple was moving the smartphone market ahead so quickly, so much more quickly than Nokia, Ericsson, and Motorola, that it had to design its own chip. And the rest is history. Tesla is the only auto manufacturer to have designed its own AI chip. And our analyst, our AI analyst, James Wang, who spent 9 years at NVIDIA, took a look at the specs of that chip and said, Tesla is 4 years ahead of any other autonomous or auto manufacturer. The other way it's ahead is with data. The winner in an AI project has the most data and the highest quality data. Tesla has 14 billion plus miles of real-world driving data, while Waymo, the closest competitor in this regard, has 20 million, 14 billion, 20 million, and Tesla has 700,000 cars out on the roads. You could consider them robots collecting this data and sending it back every night. And they have the best AI team, we believe, not just in the auto industry, but maybe in almost any industry.
Cathie Wood remains bullish on Tesla despite her firm reducing its holdings. While ARK Invest trimmed its Tesla position by 28% in Q4 2024, Tesla still makes up 11.06% of its portfolio. This move raised concerns, but Wood clarified that ARK's strategy involves rebalancing positions while maintaining long-term confidence in high-growth companies like Tesla. Key reasons for Cathie Wood's Tesla optimism: autonomous driving and full self-driving, FSD. Cathie Wood strongly believes Tesla's full self-driving, FSD software will be a game changer. She sees significant progress in Tesla's AI and expects self-driving technology to unlock new revenue streams. If Tesla successfully scales FSD, it could revolutionize personal and commercial transportation, making Tesla much more than just an automaker. Robo-taxi network potential. Cathie Wood predicts that Tesla's future robo-taxi network will be a major growth driver. She has previously forecasted that Tesla could achieve a multi-trillion-dollar valuation if it successfully launches autonomous ride-hailing services. This would allow Tesla to compete directly with Uber and Lyft, but at much lower costs, given Tesla's vertically integrated model and battery efficiency. AI and robotics. The Optimus factor. Tesla's AI capabilities extend beyond self-driving cars. Wood is particularly excited about Optimus, Tesla's humanoid robot, which she sees as a potential game changer in automation and labor markets. If Optimus becomes commercially viable, it could disrupt multiple industries and significantly boost Tesla's revenue streams. Tesla's margins and profitability. Cathie Wood also highlights Tesla's strong margins compared to traditional automakers. Even with price cuts in 2023 and 2024, Tesla maintains healthy margins due to its cost efficiency, software revenue, and scale advantages. As FSD adoption grows, Tesla's software-based revenue could further increase profit margins, making it more profitable than competitors. Despite ARK selling some shares, Wood clarifies that it was part of a portfolio rebalancing strategy, not a lack of confidence in Tesla. ARK often takes profits from high-performing stocks to reallocate into other disruptive technologies. Tesla remains one of ARK's largest holdings, reflecting continued confidence in its long-term potential. Over the past year, Tesla has doubled in value. But while that 100% growth is incredible, has the tide turned? Tesla stock has crashed 22% from where it stood barely a week before Christmas. For a company with a market capitalization north of $1 trillion, still, that is a big fall. Is this a buying opportunity for me, or just the start of a rapid downhill road for Tesla stock? What to look at here, I do not know where the share will go from here. Nobody does. But quite a few things are making me nervous right now about whether the business merits that valuation. First is the company's car business. After years of strong growth, sales volumes last year declined, but the market overall is still growing. Tesla is increasingly being outpaced by rivals such as BYD. So while the company's total revenues grew last year and are substantial, that growth was small. At this point, Tesla is trying really hard to get investors' focus away from its EV business, mainly because of its mediocre performance. The company has long portrayed itself as a tech company, not a car maker, but the numbers at this time say that is exactly what it is, an automobile company. Tesla had 16.3% gross margins and 6.2% operating margins in Q4, which is much more akin to an auto company than a tech company. By comparison, General Motors, GM, minus 1.13%, had 12% auto gross margin and 6.8% operating margin in 2024. A hardware-based tech company, like NVIDIA, meanwhile, had about a 75% gross margin last quarter and a 62% operating margin. Musk continues to make big promises, and even on Tesla's earnings call, he made fun of the fact that he is basically the boy who called wolf. However, he said there really is a wolf this time with his self-driving car. However, even if the company is getting close to autonomous driving, it is still behind Alphabet's Waymo, which already operates in a number of U.S. cities, and the economic model is still unproven. Here are 5 compelling reasons to buy Tesla stock in 2025. The first one is leadership in the electric vehicle market. Tesla remains the global leader in EVs, with a strong brand, innovative technology, and a proven track record of delivering high-demand products. By 2025, Tesla's product lineup, including the Cybertruck, Tesla Semi, and potentially a $25,000 compact EV, is expected to drive significant growth. Tesla's focus on vertical integration, for example, battery production in gigafactories, ensures better control over costs and supply chains. The growing EV market, supported by global regulatory efforts to reduce carbon emissions, positions Tesla to capture a significant share of the industry's growth. The next reason is growth in autonomous driving technology. Tesla's advancements in full self-driving and autonomous vehicle technology are expected to be game changers. The potential for Tesla to launch a robotaxi network could revolutionize transportation and create a high-margin recurring revenue stream. Tesla's Dojo supercomputer enhances its AI capabilities, giving it a competitive edge in the race to perfect autonomous driving. Even partial adoption of FSD by Tesla's existing customer base could contribute billions of dollars in annual revenue. Number 3 is diversified revenue streams. Tesla is no longer just a car company. Its diversification into energy storage, solar solutions, and software subscriptions provides multiple growth avenues. Energy storage. Products like the Powerwall, PowerPack, and Megapack cater to the growing demand for renewable energy storage solutions. With increasing adoption of solar energy globally, Tesla's solar roof and solar panels represent a long-term opportunity. Software and services, FSD subscriptions, over-the-air updates, and other Tesla software offerings will generate high-margin, recurring revenue. Reason number 4 is expanding global production. Tesla's gigafactories in Texas, Berlin, and Shanghai, with potential new factories in India and Mexico, are expected to significantly boost production capacity by 2025. Tesla's ability to scale production efficiently positions it to meet growing demand in both established and emerging markets. Increased production capacity will likely reduce per-unit costs, improving profit margins. The fifth reason to buy Tesla stock is strong financial position and innovation. Tesla's ability to innovate and execute has been a hallmark of its success. By 2025, the company's focus on innovation and financial discipline is expected to strengthen further. Tesla's profit margins have consistently outpaced many traditional automakers thanks to its efficient operations and high-margin software sales. Continuous innovation, from battery advancements to renewable energy solutions and new vehicle designs, Tesla's commitment to innovation ensures it stays ahead of competitors. Tesla stock in 2025 presents a strong case for long-term growth investors. Its leadership in EVs, advancements in autonomous driving, diversified revenue streams, global expansion, and commitment to innovation make it a compelling investment. However, as with any investment, consider potential risks like economic headwinds, regulatory challenges, and increasing competition.